back in 1920, an ounce of gold and a £20 note was worth exactly the same. Both could afford, a man or a lady, a handmade suit. And if we fast forward to today's times, effectively that £20 isn't enough to purchase the necktie for that suit. But the ounce of gold is worth roughly over £1,600 per ounce. What are we protecting ourselves from? And so, there are the foreseeables, the predictables. We are likely to see inflation again. And so, inflation right now, regardless of what you choose to take into account as the measure of inflation, it's certainly higher than any return you can get on the money in your bank, right? Or the money, from, a low risk bond. And so inflation is a huge driver. Inflation you can predict. You've got rising interest rates. Again, this has happened before. Rising interest rates pushes up the cost of debt, which pushes up potentially the likelihood of people not being able to pay their mortgage, which therefore affects the property market. You've got recessions, equity crashes. These are cyclical. By their nature, they tend to happen every 10 years or so. So within reason, we can predict that they're going to happen. Yes, we might not know exactly when, but we know at some point we're going to see a correction in those markets. What we can't predict are the unknown unknowns, the black swan events. And, what I'm referring to here is the likes of, Brexit referendum, then actually, us departing from the EU, COVID, a pandemic, all of the other consequences that resulted from that. And then, of course, the current and ongoing war that we're seeing right now in the Middle East. These are things that you can't necessarily predict, but you can anticipate. We're not acting on perfect information, but I think what we've come to realize is that things that we're not expecting, things that we're not aware might occur, tend to occur. And so physical gold does a really good job of protecting people's wealth during times of uncertainty, whether or not it's predicted or not, because it's physical, it's tangible, which means that you can see it and you've got complete autonomy. You control your investment. You're not having to rely on a counterparty. So, for example, during times of rampant inflation or a recessionary environment, or during an environment whereby we're seeing more businesses close every week than we saw back in 2008, people are starting to lose faith in counterparties. How safe is my money? If I can't see it and I can't touch it, how am I able to get access to it? We've seen all sorts of funds over the past, the Woodford Fund and others, whereby people have tried to get money out quickly because they've seen the writing on the wall, only to be blocked by the fund saying, actually, we're not allowing you to redeem your investment. And so, being able to have something that is physical and tangible, something that you're not having to rely on a counterparty for, is really, really important, because you're not having to rely on anyone else. There's no guarantees with anything. You go to bed at night and there's no guarantee over what the gold is going to be worth in the morning. But what you can guarantee is that it will be there, right? And so when we're talking about equities or investments in other businesses, you can't make such a guarantee because the value of those investments can go to zero and therefore distinguish themselves. Whereas physical gold, it has an intrinsic value, right? It's impossible for it to go below zero. It's very difficult for it to go below the cost of getting it out of the ground and the logistical cost of getting it from the mine to the refinery, to the mint, and to our customers' hands. And so, going back to you asking, why is this so important? I guess there's almost a muscle memory whereby during every single recession that we've ever seen during mankind, bar none, we've seen gold step in as a means of protection. And the symptom of that is that the gold price will go up, whereas commonly held assets like equities and property and demand for bonds go down. So there's a very strong correlation between those two asset classes, a yin and a yang, if you like. The example that I often give with inflation, and if we take into account that the true definition of inflation is the rise in costs of commodities and services. And so by its very definition, gold is included within it. And back in 1920, an ounce of gold and a £20 note was worth exactly the same. Both could afford, a man or a lady, a handmade suit. And if we fast forward to today's times, effectively that £20 isn't enough to purchase the necktie for that suit, right? But the ounce of gold is worth roughly over £1,600 per ounce. And so whether or not you look at the fact that gold has increased by 11,000%, or whether or not you look at the fact that gold has outperformed inflation, the key here is that, on the one side of things, it's just numbers. And numbers mean nothing in relation to the things that you want to use those numbers for. We're not here to just kind of accumulate wealth and not use it for certain things, even if we plan on giving it to our family members. And so it has to be pegged to the things that we purchase. So at the very least, you want to ensure that it meets the rising costs of those goods and services, or it outperforms it. And gold has that track record of doing that.
If you're ready to take action and safeguard your wealth, then visit danastingregory.com/gold to download your free guide and take advantage of a free consultation to explore your gold bullion options.